Everyone keeps asking the same question. If Australia has a housing shortage, why are Sydney property prices falling? Think about that for a second. We've been told for years that Australia doesn't have enough homes. We've been told immigration is high. We've been told demand is strong. So shouldn't prices keep going up? Yet Sydney's property market is suddenly cooling. Homes are sitting on the market longer. Auction clearance rates are dropping. Buyers are pulling back. And some experts think this could be the beginning of a much larger downturn. But here's the interesting part. The reason has almost nothing to do with houses. It's actually about something far more powerful: money. And once you understand how money flows through the housing market, Sydney's slowdown suddenly makes perfect sense. Here's the first thing most people don't understand. A house doesn't sell for what it's worth. It sells for what people can afford to borrow. That might sound like the same thing, but it's not. Imagine you're buying a toy. If you have $20, you can buy a $20 toy. If you have $100, suddenly you can buy a much bigger toy. The toy didn't become better, you just had more money. Housing works exactly the same way. Most buyers aren't paying cash, they're using bank loans. That means house prices are heavily determined by how much banks are willing to lend. Not how beautiful the house is, not how many bedrooms it has, not even how scarce it is. The real driver is borrowing power, and right now, borrowing power is shrinking. Let's say 2 years ago, a family could borrow $1 million. Now, interest rates have risen. The bank looks at the same family and says, sorry, based on today's repayments, you can only borrow $850,000. Same family, same jobs, same income, but suddenly they have to buy a cheaper house instead. This is what economists call a reduction in purchasing power. Most people think interest rates only affect monthly repayments. That's only half the story. The bigger impact is what happens before you even get the loan. Higher rates force banks to become more conservative, so buyers lose borrowing capacity. And when thousands of buyers lose borrowing capacity at the same time, house prices start falling. Not because people want cheaper houses, because they literally cannot afford the previous prices anymore. It's like everyone showing up to an auction with smaller wallets. The seller still wants $1.5 million. The buyers only have $1.3 million. Eventually, someone has to give in, and it's usually the seller. Now here's where things get even more interesting. Interest rates aren't the only reason buyers are nervous. The federal government recently proposed changes involving things like negative gearing, capital gains tax calculation, minimum tax on discretionary trust. Most people hear those words and immediately tune out. But here's the simple version. Many investors buy property because of tax advantages. The government allows them to reduce tax bills through various mechanisms. Those benefits make property investing more attractive. If investors think those benefits might shrink in the future, they start asking, will this investment still make sense? And uncertainty is a poison for property market. Because when people are uncertain, they wait. They don't buy. They don't sell. They sit on the sidelines. Imagine a game of musical chairs. If everyone suddenly stops moving, the entire game slows down. That's exactly what's happening in parts of Sydney right now. The market isn't collapsing. It's hesitating.